This episode is brought to you by LifeLock. It's tax season, and we're all a bit tired of numbers. But here's one you need to hear. $16.5 billion. That's how much the IRS flagged for possible identity fraud last year. Now here's a good number. 100 million. That's how many data points LifeLock monitors every second. If your identity is stolen, they'll fix it. Guaranteed. Save up to 40% your first year at LifeLock.com/podcast. Terms apply.
This episode is brought to you by Honda. Introducing the all-new, all-terrain Honda Passport Trail Sport, the most off-road capable Honda Passport Honda has ever dreamt up. The Passport features increased ground clearance, roof rails on all trims, and available specially developed all-terrain tires. And you'll stay comfortable with tri-zone climate control and available features like heated and ventilated front seats and a panoramic moonroof. Learn more at honda.com/passport.
Welcome to Don't Retire, Graduate, the podcast that asks you what you want to be when you grow up so you can graduate into retirement with a purpose and with a passion. I'm your host and valedictorian, Eric Brotman, and we're excited to be bringing Season 6 to our growing audience. We'll be bringing you interviews with amazing guests every other Thursday, and on alternating weeks, we're hosting a new segment called Diary of a Financial Advisor, which we know you'll all enjoy. So please, subscribe, leave reviews, check out our all-new episodes every Thursday, and thanks for joining us today. Today, I'm pleased to be joined by Veena Jetti. Veena is the founding partner of VIVE Funds, a unique commercial real estate firm that specializes in curating conservative opportunities for investors. She brings a dynamic perspective to targeting, acquiring, managing, and operating assets using best practices combined with cutting-edge technologies. And her professional expertise includes driving corporate strategy and business development opportunities. And we're excited to have her on our show. Veena, welcome to Don't Retire, Graduate.
Thank you for having me. I'm so excited to be here.
This is going to be very, very interesting because your space is one that financial advisors wrestle with, because a lot of financial advisors do not have the technical expertise in the real estate world. And interestingly, a lot of investors, particularly do-it-yourselfers, favor real estate over some other things. So there's sometimes a conflict between what do-it-yourselfers are doing and what client advised or advised clients are doing. And so I'm hoping we can break that down. But I want to begin with your background and how you got into this business.
Yeah, thank you. I think that this is absolutely an important discussion and conversation because I echo this experience. So I'm excited to dive into that. As far as my background, so I am an accidental private equity fund manager. I did not think that this is what I was going to be doing. If you asked me when I was a kid, this was not what I had, and even in my top 10 list. And so I graduated from the University of Illinois in Chicago at 20 years old with a degree in finance. And my mom said, hey, come work at the family business, because she's a single family investor. She had a very successful investment career. And I said, okay, Mom, I'm an adult and I have a degree. I'm going to go do something that is completely different, and I'm not going to come work for you. And I went out into the corporate world and ended up in corporate real estate and worked for some of the largest companies in the world. My most recent corporate gig, I left in 2012 at Tishman Speyer. And, they're a multi-billion-dollar real estate private equity company. And so started there, learned very quickly I'm not a very good worker bee. And so I had to leave corporate America to start my own company, started in single family investing like many people do, because I just didn't know that Veena Jetti could own multifamily. I thought only like Oprah and Jeff Bezos and Elon Musk and like all of these billionaires could own it. I didn't think people like me could. And so I had a friend who reached out to me and said, hey, let's buy a multifamily complex. And I was like, yeah, what could possibly go wrong? What do you mean? He was like, I have this 200 unit deal in Dallas, Texas. Let's go buy it. And I was like, yeah, okay. So that was my first deal. It ended up being the hardest deal I ever did, but also was very lucrative, very profitable. And once that world opened up to me, I just kept going. And now we've done over $1 billion in multifamily transactions.
That's amazing. Although I don't think you've been completely honest with us. I know when you were 8 and someone said, "What do you want to be when you grow up?" You said, "I'm thinking about private equity.
That is
I'm
true.
going to manage
That
real
did
estate."
happen.
I know that's what really happened. So if you would just be honest with us, we could have a much better conversation.
All right, you want the honest truth.
Yes.
It
No,
was
I want to
actually
know
when I
that
was 7. I decided to be a private equity fund manager.
Yes. Everyone else was saying ballerina, astronaut, professional athlete, but no, private equity manager.
Laser focus.
So, real estate is something that I encourage people not to dabble in. Like anything else, real estate's a business. It's an industry. It's not a hobby generally. Yes. And I think if we learned anything in 2008 and 9, it's that real estate doesn't always go up in value. We've had some really good runs with low interest rate environments and some things, but the argument always was, well, they're not making any more land, which, okay, that's true. Yes. Land is finite, although zoning is not. Yes. So what do you say to folks who think that real estate, either they have a short memory and think real estate only goes up, or they have a long memory and are totally afraid of real estate because of that experience? I mean, you have two different folks based on generation, I would think.
Yeah. So I actually disagree with you a little bit. So
excellent.
I do say real estate always goes up. And what I mean by that is if you look historically over long periods of time, the trend is upward, right? Like, yes, there are blips. Yes, there are downturns, and real estate is cyclical. But when we say it always goes up, we mean over long periods of time. And I think you're exactly right. People try to dabble in real estate, right? Like, and I started the same way. I watched Fix or Flip, and I saw my mom doing all this single family, and I was like, oh, I'll just do this part-time on the side. It'll be great. And I'll go on vacations all the time and live this lifestyle that's going to be paid for by my passive income in real estate. Very common story. However, that is not how it actually works. And I think the people that always get burned the most in these downturns, like we saw in 2008, we're in the middle of one right now. The people that get burned are the ones that I like to call them real estate tourists, right? They're here because it is shiny. Everything that glitters is gold, without really understanding the underlying fundamentals. And look, most investors right now are facing some sort of hardship across our portfolio, and us included, right? Like, we're seeing less deals than we have ever seen. We're doing less transaction volume than we've ever done before. Cash flow is constrained. Cap rates are expiring. So there's a lot juggling, rate caps are expiring, cap rates have expanded. So there's a lot of different forces happening, and we're starting to see the result of that now in the market. So when someone comes to me and says, I don't like the risk of real estate, I always ask them what they mean by that. Like, why don't you like the risk of real estate? Usually it's because there's a knowledge gap and there's a time and management issue, right? It takes a lot of active management to manage real estate. I have an entire team across our portfolio that manages our real estate. We have analysts, we have CFOs, we have investor relations coordinators, we have admins, we have property management. So we have a lot of different individuals that make this work. It's not me waking up going, oh, I think I'll buy an asset today, and then hoping for the best. We have to underwrite. We have to perform due diligence. We need to be up to speed on what capital markets are doing, what is available out there. So I think it is a misnomer for anybody who says I want mailbox money by being an active investor. That's where we come in, right? The passive side. So our investors are entirely passive. Once they decide to invest with us, they don't do anything else. Like, they don't worry about how many leaky toilets there are, right? Our property management does that, and we manage the managers. So I think it really depends on the level of effort you want to put in and what kind of return you're seeking. If you're seeking a double-digit return and you don't want very much work, then sure, being an LP makes sense. If you want like a 20%, 30%, 50% return, which is possible with the asterisk of none of these returns are guaranteed. But if you want a higher return, then you need to be an active investor, and that takes a full entire business plan and business model, and it's a career. It is not something you dabble in.
So you said an awful lot there that makes sense to me. So even though we started with a disagreement, I think there's more harmony than disharmony. I will say that the reason why professional investors like yourself eat you call them tourists for lunch, is because you can wait out these blips. I mean, you have the resources, the depth, the experience, the history, at the patience, the knowledge, and hopefully the team to ride this out. Whereas people who dabble, or people who think, I can do this myself, are much more prone to panic. You kind of remind me, I think you might be the Warren Buffett of real estate. So I'm very excited. We talked about Elon Musk. We talked about Jeff Bezos, but I'm getting a Warren Buffett thing here, because he always said, be greedy when others are fearful, and fearful when others are greedy. You can't do that if you're in the horde that's going to be fearful at the same time. And those are the folks who get trampled by folks who know what they're doing. And I'm making you the trampler, not the trampolee in that conversation. But
I know, you aggressor.
Well, I mean, but I mean, first of all, that's capitalism. I do not invest in real estate in the way that you do. I certainly have some investments and own some property, but I typically am looking to buy and hold, and I'm not a landlord to anyone. And that's been my decision. I will say that when I bought a second home, I bought it in the wake of the 08-09, and I feel like I stole it from somebody. I almost feel badly, except that it was a willing buyer, willing seller situation. But I bought it for a song, and it is a spectacular place, and we enjoy it all the time. So, is it predatory, or is it just good business? I guess it's mostly just good business, but it's also opportunistic, yes?
Yes. It's opportunistic in one light, right? In the other light, you're also solving a problem for someone who has a pretty big problem. Now, I think we're talking about like more the ethics of real estate investing now, which I actually really like this topic, because I think it's not talked about enough. And I think actually this is a really good time to be bringing it up, because I've been talking about this on my social media a lot, is in the wake of the California fires that are happening. Every time there is a major natural disaster, you will always see the unethical real estate investors who come out and go, your house just burned down. Let me make you an offer for your land while you're still driving to safety. That is, yes, it's opportunistic, but it's unethical in my opinion. And I know there are people that are going to go, oh, but I'm solving a problem for them and they might not want to worry about that. No, you're not. You are taking advantage of someone who is in a vulnerable state, and that is not acceptable. When we're talking about the 2008 crash, right, and we were in the market then, my family has been in the market for 30 plus years. So we have a lot of familiarity with all of these different market cycles that we've experienced. And what I would say is, after 2008, if you have a willing seller who is not in some kind of major chaos or distress outside of having probably made a bad decision or maybe not like a well thought out investment decision, and is looking to liquidate and make it as painless as possible in the circumstance, I think you're solving a problem for them. And that's part of why we can make money in real estate, is because it's just such a fragmented and disaggregated industry that there's a lot of friction points and a lot of inefficiencies. And we're really exploiting the inefficiency in the market more than anything else.
So I don't know if I don't know how you feel about the various real estate sites that send you an estimate of your home's value every, say, 6 weeks. I find it a little bit amusing, actually, that the value of my home goes up and down so much that it's as volatile as any portfolio that I could own. And I actually think a lot of homeowners and investors, if they did have to get a statement for their home every month, would potentially be very nervous about it, because it does look like, if you're dealing with comps, you're dealing with your next door neighbor just sold under duress, and it makes your property less valuable temporarily.
100%.
But this is a lot of this is single family stuff. The multifamily, I think, really over the last decade has become a big deal, partly because it's getting more and more difficult for individual consumers to buy homes. So there's been a need for apartments, and some of that is political, some of it's economic, some of it's just the state where we are. And of course, inflation over the last number of years has played a role in that, and interest rates. It's not as easy to qualify for a mortgage, and it's not as easy to get one favorably anymore. So when money gets more expensive, there's less of it, right? But on the multifamily side, there's been a growing need for apartments. And I guess my thought is that, and I've always invested based on what I call the taxi cab theory. And I know we have Ubers now, not taxi cabs. But my thought was, whenever I was in the back of a cab, because I travel a lot, and the cab driver started telling me about their tech stocks, and it was 1999, I knew it was time to get out. Yeah. When they were starting to flip properties in 2008, I knew it was not like, it's almost like the writing is on the wall immediately when everyone's doing it.
Yes.
So have we overbuilt apartments? Are we oversaturated? Is the next wave of this potentially going to be scary for investors?
No, we have not overbuilt apartments. And in fact, COVID, we still have a lot of lagging indicators from COVID for builds that were paused at that time. And we're still trying to catch up to that. And despite all of the build that has been happening, at least in our markets, and I should say all of this is market specific, right? If you're going to be investing in a market that is a declining population and there's 4,000 units coming online, then yeah, that's probably a bad move, right? So it's very market specific and market driven. But generally speaking, as like a broad topic, multifamily is still in very high demand. Absorption is, we need more units, actually. We have a shortage of housing. And as you said, single family homes are becoming more and more inaccessible to the everyday American. And so a lot of people are turning to rental communities, rental homes, apartment complexes. And part of what's driving the unaffordability in the single family space specifically is you have companies like Blackstone or BlackRock and like all of these major private equity firms. I'm talking billions of dollars. They have unlimited amounts of money. They're going in and they're buying single family homes, and they're not buying one single family home that's like a $10 million home that you're not buying. They're buying $200,000 to $500,000 homes, and they're buying entire neighborhoods at a time, which is driving the shortage for single family housing. And we're seeing an influx of people that would have otherwise maybe bought when interest rates were sub 3%. They were buying homes, and now they can't afford to buy that same home because now interest rates are what, like 7%? I don't know what it is in the single family space, maybe like 7-ish percent, 6.5%. And to your point about valuation, it's not valued based on the home. It's valued based on what your neighbor decided to sell for in the last 6 months. And, you know, I have single family in my portfolio. I try not to, but I do. I accidentally buy a house every now and then. And I've
never heard anyone say that to me before, by the way. No one's ever accidentally bought a house. Like, sign here, oops. But
yeah,
okay.
That's like kind of what happens.
I'll give you a pass. Are you literally signing whatever people put in front of you? Because if you are, I'm going to send you a lot of mail. Okay, good.
No, and I'm like the annoying person who reads everything. Like, I redline my rental agreement at like the car rental place. So I read everything. When I say I accidentally buy houses, I never, ever, ever intend to buy single family homes, like ever. And then I'll see a house and I'm like, oh, you know, the fundamentals are really great. Like, let's just go buy it and then we'll figure out what we're going to do if I'm going to manage it. And I always regret buying every house I buy because it's not scalable. It doesn't scale. So like I bought a house that I got on a really great deal, and I assumed a 2.5% mortgage or something crazy low. And it's 4 bedrooms in Orlando, and someone else manages it. So I don't really worry about it a whole lot. But like every time I have to even think about it, I'm like, oh, what a waste of my time, because it cash flows like a couple $100 a month. It doesn't scale well. And so that's why I accidentally buy single family homes, is what I would say.
So if, you know, I was going to say, if you're accidentally doing this and every time it goes wrong, who is your accountability partner who's going to sit down and say, Veena, we talked about this, stop it? Like,
it doesn't go wrong financially. So it's hard to say, oh, okay, I shouldn't have done that, because, you know, we still make money from it. But it's just like, I don't like thinking about single family homes like that. I only like thinking about single family in the context of multifamily.
So our audience is pre-retirees and folks who are contemplating the next chapter of their lives, because I naturally encourage no one to ever sit around and watch daytime TV and not be gainfully and productive and so forth. But a lot of folks don't have, they're like you were, which is, wait a minute, can I really do this? Can I participate in this? And the vast majority don't want to do what you do for a living. I mean, let's face it, that's a career and it's a major operation. But for people who want to try and participate in this, but in a very passive way, that's where firms like yours come in. Yes, you're able to assist with the relatively, I'm going to call a small investor. And you know, I don't know what you consider a small investor to be, or whether you're looking for ultra high net worth families to participate, or whether you're trying to build something that's more accessible. Talk a little bit about that. Is this for accredited investors? Is this only for people of certain means? Like, how does that work? Everyday folks probably shouldn't do this. Yes.
Yeah, everyday folks should not do this if you're not going to put in the dedication and hours and knowledge and just sheer blood, sweat, and tears it takes to do this. But to your point, you can participate as an LP or a limited partner. First and foremost, you know, I have to just say this disclaimer that we do not provide financial advice. I am not licensed to give you any kind of financial advice. And if you have a financial advisor, this is absolutely something you should be discussing with them, because they have a holistic view on what your risk tolerance is. And there is risk in these investments. You could lose all of your money without question. That is on the table. And so I would say if you are interested in real estate, and these are very tax efficient investments because we do produce negative K1s for our investors, what I would consider to be, I don't consider any of our investors small investors. All of our investors work really hard for their money. And so whether they're writing me a smaller check or a larger check, it doesn't really matter. We treat all of our investors the same. So I'll start there. Our minimum investment is $100,000. Now, there are other firms like our competitors and colleagues in this space. They sometimes will take like $50,000, or some will take $25,000. It just really depends. I always recommend that you don't take $25,000 investments because the administrative cost is just so high. It almost doesn't make sense to do that. So I would say you're looking at roughly $100K if you're working with us. If you're working with another company, probably around $50K. And you really have no active responsibility. But this is a space where we are selling an exempt security. So this is not like when you go and buy a publicly traded stock on the stock market, right? There is a certain level of transparency and accountability that you will find in publicly traded companies. In this space, we call these like PPMs, private placement memorandums, and we do still have to follow securities rules. Whether everybody does is a different conversation. But for us, the securities exemption that we rely on is the Reg D 506C, which means that we can only accept accredited investors into our deals. And we do third-party verify that. So your financial advisor, your tax strategist, your lawyer, someone is going to have to tell us, a third party is going to have to tell us that you are an accredited investor. But there are also offerings under Reg D 506B, like boy, that other colleagues in the space will offer. And those are totally private, meaning that if I was running a 506B deal right now, I can't get on here and solicit and tell you about it. You have to have a pre-existing substantive relationship with me to get into those deals.
Wow. So there is sort of a behind the curtain Wizard of Oz kind of thing happening with some of these deals. I mean, this is a who do you know and so forth, which it sounds like that's not Vive's way. And that's not the way you do business, but they do exist. And, you know, there's a certain, there's some public policy stuff here. And I you know, I'm not Pollyannish. Okay. I understand that, and I'm a big believer in capitalism. I think it's a beautiful thing, quite frankly. However, when a BlackRock is buying full neighborhoods, I can't imagine that's in the public's interest in any way, shape, or form to even allow that kind of thing. And I know they'll be angry if they hear this show, although I don't know how much pull I have, Veena. But is that, from a public policy standpoint, is that a slippery slope? I mean, could we see zip codes owned by huge companies at some point where it's like we already do. I mean, Disney owns Orlando. We know that. But are there other situations where, you know, literally a private equity firm could own every constituent of a post office? I mean,
yes, there are situations in which this is already happening. Also, I'd like to clarify for the record that I own one single family in Orlando, so Disney does not own all of Orlando.
Okay,
Everything
but
except
they could
one house
squeeze you
for
out.
sure.
They could make you a ridiculous deal that would make you say, fine, it's yours, and I'm out.
Yes, Disney, if you're listening, please make me that offer because I am so out so fast. Just tell me where to sign.
Well, you just made yourself easy prey. They're going to lowball you now, but all right, fair enough.
I didn't say it was going to be stupid, but I am so willing to get rid of it.
Okay, all right. Well, I've always wanted to move to Orlando. We'll talk offline.
There you go.
So at any rate, from a public policy standpoint, you're saying this is already happening.
Yes.
I'm not hearing about this. Why am I not hearing about this? Why is this not newsworthy?
Because this is what private equity has always done, right? And I think people get outraged at smaller landlords for owning a commodity like housing. And I do understand what the concern is there. But I think on the other side of that is you are revitalizing a community. You are investing into a community. And that's the view we take. Like, this is someone's home.
Mm-hmm.
I don't know what's more important than that, right? Like, your children are going to be raised here. Your memories are going to be created here. And that's important work for me. And if people like me don't do this, who's going to do it? Right. And so I think that a lot of times the concern, the anger, especially of millennials, Gen Z, Gen Alpha, I guess is the next one after that. The concern or anger is very misdirected toward small time landlords versus going and saying like, hey, BlackRock, we don't want you to deploy $10 billion into buying single family homes, or, maybe even demanding some kind of guardrails around that. I don't actually know, because I too am a capitalist, right? I like to think of myself as a conscious capitalist, but I don't know what the answer is. I don't know how you solve for that, because the government intervening, I don't think is the answer. We see that already with Section 8 housing, and it's like not great.
Yeah. No, the government is never the solution to anything, just to be clear. Government's never the solution, but if this kind of thing were making news in a way that was objective, and I know objective and news don't always go together anymore. And you sound like a proud Gen Xer. Are you a proud Gen Xer like me?
I wish I was a Gen Xer. I'm an elder millennial.
Ah, well, that explains so much. That's why we argue. All right, so
probably I'm married to a Gen Xer though.
Well, and rightly so. We're small, but mighty. Tell them
the forgotten generation. Isn't that what you guys?
So Gen X, by definition, we were born between 1965 and 1980. We were completely unsupervised, and it shows.
Latchkey kids.
We were latchkey kids.
Generation.
We literally raised ourselves. We were. The joke is that we were 30 when we were 12, and we're still 30 in our 50s. It's called arrested development, and I am very much the same as I was when I was 12, but with a little more money and a little more body weight and a little less hair. But other than that, I'm still 12 on some level. So I could talk to you all day. This has been both informative and educational, and also a lot of fun. I have to ask you an important question, because I know you didn't answer this properly when you were 7. So this is another chance. It's a chance, Veena, it's a chance to be honest with us too, because we know that was a little bit questionable early on. And that's what do you want to be when you grow up? What is this elder millennial stateswoman want to be when she grows up?
Oh gosh, this is such a hard question. Because I feel I'm one of those people that I'm like, oh, if I really put my mind to something and I just never give up, I feel like I can accomplish it. So I don't know what I want to be when I grow up, because it's just changed so much in the last few years itself. But I could tell you, if I could do any job in the world, I get asked this relatively often. Like, if you're not doing real estate, what's the job that you would have? And I know this in my soul of souls. I would do one of two. I would want to be one of two things. I want to either be the person that names storms, or the person that names nail polish colors. I don't know which, but one of those two things.
As life goals go, that was a unique answer. So I give you full credit for thinking about that. I don't know a whole lot about either of those industries. I don't know how competitive it is to get into those. I know that whenever you buy paint or you buy something, in various retail outlets, the name for the colors are preposterous, and someone's being paid to do that. But who knows? Maybe it'll be you. We'll have to follow your career and see if that's the direction it takes.
Yes,
I have great confidence.
In my old age, I might do that.
Well, you've got a ways to go. So how can folks learn more about you and more about VIVE?
So you can go to our website, vivefunds.com, VIVEFUNDS.com, if you want to learn about investments and investment opportunities. If you want to connect directly with me, I answer all my own messages on Instagram. It's the only place I respond to everything. So I'm Veena Jetti on all social media platforms, VEE, and like Nancy A, JETTI.
Okay. Well, we're all going to stalk you on Instagram, which sounds
amazing.
Fun. I do have to ask you, since I have you in the hot seat and we just saw your website on screen, what do you call that shade of purple for those buttons?
I would say that this is more of like a burgundy than purple, but I want to name it. Like, I want it to be a creative name.
So there it is again. And you're calling that burgundy.
Color. It's
you
like
think
a berry,
that's burgundy?
More of a berry.
I'm going with boysenberry. I'm going with boysenberry. That's my final offer.
I think a boysenberry is more blue.
Okay. Well, that's okay. We agree to disagree. You millennials are impossible. Veena, thanks for being on Don't Retire, Graduate. This was such fun. I thoroughly enjoyed it. I hope our audience will not only enjoy getting to know you, but take a look at some of the things you're doing, and your conscious capitalism. It definitely resonates with me.
Thank you. Thank you for having me.
I'd like to thank all of you for listening and watching today. If you enjoy our show, please subscribe, leave a rating on your favorite podcast platform, and share it with your friends and family so they can join you on your journey to financial freedom. If you'd like to send us a topic or idea you'd like to discuss in a future episode of Don't Retire, Graduate, please post it on our Facebook page or tweet us at Brotman Planning. We'll be back next week with another entry in our Diary of a Financial Advisor, and in 2 weeks with another engaging guest. For now, this is your host, Eric Brotman, reminding you, don't retire, graduate.
Securities offered through Kestra Investment Services, LLC. Kestra IS. Member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC. Kestra AS. An affiliate of Kestra IS. Kestra IS or Kestra AS are not affiliated with Brotman Financial or any other entity discussed.